There's been a lot of things happening in cattle markets, and I mean you can look at the live cattle price right here, slaughter cattle price, and we've had a couple of 3 weeks that have been tough, to say the least. When I say tough, from a historical perspective, cattle prices are really, really high, really strong. But with that new level, everybody that has purchased cattle, and then they're any margin operator, so a stocker operator, a backgrounder, a feedlot, packers, any of those margin operators, they've paid a lot of money for certain animals, and then they're not being able to sell. They're selling them on a lower market now, which results in losses from that standpoint. So prices are really high, still really strong, just not everybody's going to be profitable because we've had this dip in prices. Now, we have had, well, I'll come back to that. Let me just hold that thought for a second. But here, we're 232, 233 is where finished cattle uh, traded last week. We hadn't really traded any this week, so we'll have to wait till tomorrow or Friday probably before we get any significant trade in finished cattle. I don't know. I don't like to really expect them. I mean, they might trade slightly higher, but not no big great increase in finished cattle prices. Look at 5 weight and six. I mean, 5 to 6 weight steer prices in Tennessee. Pretty much all classes of cattle, other than slaughter cows, have taken a hit the past couple of weeks, 3 or 4 weeks. You can see here in the steer price that essentially since the middle of May, prices have softened on these cattle, which is not unexpected because prices tend to peak there in the spring in that March, April, May time period. But because the futures market, the feeder cattle futures market has come off its highs by $30 in the past 3 weeks, that's driving a lot of these lower prices. So it doesn't always, fundamentals don't always drive this market. Sometimes it's just the psychology of people. And when you get good information or bad information, or let me take that, positive information towards the industry or negative information towards the industry, traders can swing that either way in reality. And so it's really just based off of perception of what they think or what people think's going to happen. And so, when I don't know how many times I've been asked about the border reopening, and in reality, that's already been priced into the market. It doesn't matter when cattle actually start coming across, they've kind of already priced it into the market. And on top of that, there's not going to be a lot of cattle coming across, at least in the initial months, just because there's not cattle in the pipeline to do that. This isn't to say, I mean, we're looking at this chart and you're still getting paid $3.80 for a 550 pound steer. It's still a really good price for our cow calf producers. They're still making a lot of money. Granted, I guess there were some meetings that I did back in the late winter, early spring, and I said, if we lose a dollar, a hundred what, or yeah, if we lose a dollar a pound on these calves, is it really that? Is it really gonna? Well, I didn't think we were gonna go from 480 to 380 necessarily in this year, but it's pretty amazing that we have, and people are still making a ton of money selling calves. Similar with these 7 to 8 weight cattle, we you know we had some really strong sales in early July. Maybe into the second, third week of July, and then uh, the yearling cattle market just kind of fell apart. So if you looked at load lots that traded the past couple of weeks or so, when you're 20 $25 off of where they were 2 or 3 weeks earlier, you really start to question, what you were doing in your marketing. Um, how many thousands of dollars did I just forego? Which, $25 a hundredweight on a 50,000 pound load would be 13,000 dollars. So, well, 12,500, but that's a lot of money to forego on a lot of cattle. And that's what we've been seeing. Now we have started to see the futures market bounce back a little bit. And I don't think we're going to go back to that 370 mark for feeder cattle futures. But I mean, what do I know? We've been there two or three times already, and then we go back down to 330 something or 340, and that's been a challenge to manage through some of that risk, and it's why risk management is so important. Just like Tori was using her fence options, using options to create a fence on your price. I mean, you can do the same thing with cattle for those that have load lots. And, an LRP insurance contract is going to essentially set a floor just like a put option. So there are things available to us as producers or to your producers that can be used. Um, but moving on, just to touch on some things that really are impacting the market, we'll get to it. But I do want to point out again that slaughter cow prices, despite finished cattle prices declining, despite calf prices declining, despite feeder cattle prices declining, the slaughter cow market is still really strong. We would typically start to see those prices decline this time of year. I don't think that they're going to decline all that much. I think they'll stay above year ago levels, and that's just because we need the lean grinding beef. We need it very bad. There's a strong demand for ground beef, and we're slaughtering so few cows relative to what we slaughtered in previous years. We need the lean grinding beef, but that's also why we'll continue to import a lot of lean grinding beef is because we need it because we have that strong demand for ground beef products. So when I talk about that, I mean here I'm talking about how much slaughter's down. So we've got heifer slaughter down nearly 11%. That's finished cattle. Steer slaughter's down 6%, and beef cow slaughter's down nearly 15%. So I generally put those numbers in your mind that we're down 11% on heifer slaughter, down 6% on steer slaughter, and down 15% on beef cow slaughter. Well, that leads us into production. And so when we have those huge declines in slaughter rates, we would think beef production would be down tremendous, but it's only down 4.8%. Well, that's because we're growing those finished cattle so much larger. Uh, you know, when we're growing these animals to 1,600 pounds of live weight, and a couple of years ago it was 1,400 pounds, and you just add 100 pounds, add 200 pounds, whatever it is, we get more product from each carcass. So that's why beef production isn't down as much. Now, alternatively, the thing with those slaughter cows, granted, we might have increased the weight of finished cattle. We haven't increased the weight of those cows. Those cows are still coming in about the same weight that they were going out last year, the year before, 2 years before, whatever it is. Now, have we increased the size of cows to some degree in this country or on farms that are in your county? Yeah, we certainly have, and there are some 1,400 pound cows, 1,500 pound cows. Some of you probably got some people that got 1,700 pound cows, but we've always had some of those, and so the slaughter weight of those cows has not really changed tremendously. So when we truly have a 14 point, what was it, six? Yeah, 14.6% decline in beef cow slaughter, it's the beef production from those animals is almost the same decline as the actual slaughter rate. So we have manipulated production by growing them bigger, and that's why those prices remain very strong for that particular animal. Now, pork production is up slightly. Broiler production's up. Well, I say slightly. I mean, when you're producing 28 billion pounds of this, a 1% increase is still a lot of meat. You take broiler production, which would be close to probably 50 million pounds or 50 billion pounds a year, and you increase it by 2.6%. That is a lot of extra protein, a lot of extra protein. So when we put this into perspective, those two industries are trying to take advantage of the high beef prices and trying to capture some of the profit because pork prices and chicken prices have been able to increase at the same time because beef prices are so high. But we do know at that same rate, we know that beef is the leader at the meat counter, and that's the preferred meat protein for most consumers. But when price goes up, there is some people that trade down to other products, and so the pork and poultry industries are going to take advantage of it in some form or fashion. So they've increased production to hopefully increase a little bit of profits in their businesses. We'll eventually get June data here in a few days, I guess, for imports and exports of beef. But we continue to have strong imports. We'll continue to have strong imports because we need the lean grinding beef. We've had softening exports. We'll continue to have soft exports compared to a year ago because we're not producing as much of it and it's terribly expensive. And so, as we've always said, you know, if it's higher price, people are going to purchase less of it. And that's the same with the export market. And we just have less of it available to go out anyway. I'm not going to spend a whole lot of time on well, we can, I guess. Uh, so looking briefly here, there's Brazil. We're importing a lot of beef from Brazil. They're, pay the tariff. They're fine with that because the prices are so high that it more than pays for itself to continue to ship it here. At the same time, China always plays into this in some form or fashion. And Brazil was a or China was a large destination for Brazilian beef. But China is trying to rebuild, uh, they're trying to strengthen their pork prices, realizing that China is primarily a pork eating country. They have increased beef consumption considerably, but they're still primarily a pork eating country. And their domestic pork market is not very strong. And so they've even limited beef imports from Brazil. Uh, so, use some trade tactics to limit the quantity of beef coming from Brazil into China to actually support their pork industry. And so with the fact that you take that market away from Brazil, well, we being the U.S. become the optimal market for that extra beef that's sitting there that would have typically gone to China. And so, you see that solid blue line, it almost looks black to some degree, but uh, we're going to continue to see that beef come into this country because they really don't have another outlet for it, and we need the lean grinding beef that they have available, and we're going to continue to see it. Of course, Australia is a strong market to pull in, which they ship a lot of beef to China as well. Being in that region, they're trying to gain more access to Japan and South Korea. We'll see how that plays out. But of course, Canada and Mexico, and then New Zealand being like Australia, all major players. And we'll see, even with the reopening of the border to live animals coming from Mexico, we'll see if we end up seeing more shipments of beef from Mexico as they develop their processing capacity more in the coming years. From the export side, I mean, it's just amazing. If you look at the trend from 23 and just look at our two biggest markets there being Japan and South Korea, um, from 2023 through current, you can see a definitely a trend line that's trending lower in those countries. And you can see it, you can also see it there in Canada and Mexico, kind of from 2024 on. If you just use those short time frames. And that all is related to when prices started increasing for beef in this country. And so, not that these countries don't want the beef, it's just that they're not going to pay that much for it. So they have reduced how much they're willing to pay, or not, they hadn't reduced what they're willing to pay. They've reduced what they're importing, because we don't have as much to export and because the price is so strong. They still have a strong demand for our beef. So even though there's this negative trend line on how much product is moving to those countries, it doesn't mean that demand for beef to those countries is bad. It's actually still really strong. It's just less beef is available, higher prices. They're going to, there's less to go there. They're going to buy less because of price and less product available. And that's really what we're looking at from that standpoint. Packers, there's been a lot of struggles and challenges as Packers have lost several dollars the past year, the past several months. Still, it's a challenge. I guess the one thing that I would look at and think about is uh, when we think about the summer beef demand. Um, I guess this is something that I thought was a challenge the whole summer, and I kind of put it in the back of my mind, and I've said some things in comments, but I've never really we were ne- we never were able to push beef prices, wholesale box beef prices higher during the summer when our strongest demand for beef occurs, which is the summer grilling season, and we weren't able to push beef prices higher. I knew there was a little cause for concern. Now, at the in the same breath, and I don't mean to be speaking out of both sides of my mouth, but it might have, in the same breath, the fact that we were able to maintain such high price levels at the wholesale level for beef throughout the entire summer is pretty amazing as well. So, we've been sitting here at these essentially record levels. I realize if you look at the 2025, there's record, higher price there in late summer, where we exceeded $4, blah, blah, blah. But we've had this sustained high price for such a long time, first 6 months of the year, just strong, strong, strong. And so, even despite not being able to push prices higher when beef demand tends to be strongest, but yet we maintain a really strong price, that tells us a lot. And what it tells us is that the consumer wants beef. The demand for beef is very, very strong, but at the same time, we have found a price level where they're saying we're willing to pay this much, but not much more. Really, we're not willing to pay any more. And that's not a bad thing. I mean, it's valuable information, and so as we progress, we're going to see some of these, especially as we grow the beef herd, if we have that ability, which it looks like we're going to have that ability because at least in our part of the world, because we're getting good moisture, we've had good moisture. There should be plenty of hay resources. There should be plenty of forage resources into late summer, at least now, given that this is the fifth day of August. We should have plenty of moisture in the ground to get us through the end of August for most parts of our state in the southeast. Uh, but it's there's a double-edged sword here, kind of like it's what they talk about in the Bible is a double-edged sword, and this box beef cutout is kind of that same thing. There's some good to it and there's some bad to it, and we've got to learn how to manage around it as an industry. But overall, I think we're still at a great place. Uh, Yeah, here's the same drought monitor that Tori showed. Now, as much as I say we have the ability to restock herds, and I mean, you look at the East Coast, so you look at the Carolinas, Virginia, yeah, Florida. You look to the west where a lot of cattle are on range ground. Um, there's some challenges there. There's lots of challenges there. So yeah, people in Tennessee and Alabama and Mississippi and Kentucky, we're all going to be able to do something if we want to retain heifers. That we can do that. Most of Texas will be able to do that. But when you get out farther west and you get into even the northern plains, uh, Tori made the comment that we don't really move any markets with our corn and soybeans. Well, if you look at, I'll tell you some states that will move markets for corn and soybeans: Nebraska, Iowa, Minnesota. So even the Dakotas, so several of those states are experiencing some drought issues, and so that's going to impact the corn and soybean market. But then when you move a little farther west, and you look at states like Montana and Wyoming and Colorado, New Mexico, Arizona, all those places have a lot of cattle, or at least a sufficient number of cattle. they're not going to retain a whole lot of females. They don't have that option. Uh, so there's going to be, we're in a situation we can take advantage of growing some herds, and maybe prices continue to be elevated because other regions can't increase their herds. So just something to think about, and every producer can make their own decision, but I do think there's some opportunities because of the climatic conditions that have been presented to us. Corn prices have just been steady, 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 which has really led to uh, steady cost in the feedlot. I mean, hay prices are very regional, but this right here just gives us a kind of a trend of where prices are. We've got a lot of hay in this state. There's a lot of hay being produced, and from that standpoint, there might be good quality hay, there might be poor quality hay, but y'all know how it all is. It's all $35 a roll or whatever people say. But um, there's going to be a lot of forage available, and relative to the price of cattle, hay's pretty cheap when you think about it. So just tuck that away and see how that pencils on a feed sack. Talking about corn prices being very steady, you can see based off of Kansas feedlots, I mean, the entire year, uh, huh. I actually put in the June data yesterday, but I guess it didn't. I guess I needed to reopen the tab. It was $1.02 essentially. It was no change from May. It was just under $1.02. So I apologize. The number is actually in this chart or in the Excel part of the chart, but I guess it didn't update the line. So I apologize for that. But that point is going to be right there below 102. Steady corn prices, steady cost of uh, feeding costs. So the cost of gain has been really steady the first 6 months of the year. Probably going to continue to be steady. There's no reason to think corn prices are just going to increase all of a sudden or decrease all of a sudden. Here's the August futures market, and this is what I was talking about earlier. We've been trading in this 30 something dollar, maybe even really a $40 range uh, throughout the past 6 months, and it just keeps bouncing back and forth, back and forth. And yesterday we closed at 351.20 on the August. I know there'll be a lot of yearling type cattle that sell this month out of the state of Tennessee and out of the southeast. I do think this market will bounce just a little bit higher. Do I think it's going to go back to 370 something in August? I really don't think so. But I mean, I could be wrong, because who would have thought that it would have bounced between 337 and 377 for the past? I mean, that's just a wide trading range. So just something to think about. Here's the next essential year for feeder cattle futures. Do I think we're going to be trading August 2027 at 312? No, I don't. I really don't. I think we'll still have higher prices than that. But that's what the market closed yesterday, saying, "Oh, this is what we think is going to happen." So FYI, I think this overstates a negativeness to the market that I don't think is going to be there. But with that, we've got a couple of fed cattle price forecasts. Not that that's super important to most people on this call. I mean, we do have some folks that feed a lot of cattle, and this is important. And then, we've kind of got some information on what we think these calf prices are going to be this fall, which would be more important, these 5 to 6 weight calf prices this fall. Uh, I think I'm undervaluing yearling cattle in this, but I'm just trying to use the futures market on really, well, I guarantee you with 196, that's wrong. It's supposed to be 296 on those heifers in November. So 196 is definitely not right. But uh, nor is 480 on 5 to 6 weights. It's supposed to be 380. I know what was happening. It was late last night coming back from Blumpville, and I'm trying to get this thing done. But I think I'm undervaluing a lot of these cattle to some degree. But based off of what you can hedge these cattle for using the futures market or LRP, this is about where they are right now. So with that, I'm going to stop sharing